In this video, we'll be talking about where to invest your first $1,000 in New Zealand, or really anywhere in the world. Making your first investment can be a stressful time. There's lots of different options available to you. Do you put your money in an index fund? Do you put it in an individual stock? Do you give it to a mutual fund to invest on your behalf? Well, in today's video, I'll be giving you all the information that you need to make an informed decision on where to put your first $1,000. When it comes to stock market investing, your two main options are buying into individual companies like Facebook, Amazon, or Tesla, or buying into an ETF. And ETF stands for Exchange Traded Fund. And this is essentially security that is made to track an index or a specific sector in the market. Just as an example, there's an ETF that will track the S&P 500 index, and this index follows the top 500 companies in the US stock market, and the ETF that follows it includes all the same companies as the S&P 500, and the purpose of this ETF is to mirror the performance of the S&P 500. So if you put the stock charts for these two securities side by side, you can see that they're identical. So the only purpose of an ETF is just to mirror the performance of a certain index, or to be made up of certain investments that are part of a specific sector. So you might have the ARK Invest ETF, which is made up of new and innovative companies like Square and Tesla. Between these two investment avenues, which is the best to put your money into? Well, it comes down to risk versus reward. With an individual stock, there's more risk because you're committed to one business, whereas with an ETF, your investment is spread out amongst all the businesses that make up that ETF. If there's a few companies in the ETF doing poorly and reducing in value, there'll be other companies that are growing and overall smooth things out and lead to a nice consistent growth in that ETF. However, with an individual stock, you have to participate in all the wins and losses that that company will undergo. If it has a bad financial year and does poorly, so will you. Your investment is only as good as the performance of that individual business. So if an ETF is theoretically a safer and more consistent investment, then why do people ever pick individual stock? It's for the money. The individual companies have the potential to give you a far greater return than just an ETF. Historically, ETFs return anywhere from 8 to 10% if you're looking at something like the S&P 500, whereas an individual business can give you over 100% return. Now, this kind of return is only reserved for those who were lucky enough or smart enough to get in early on very large and well-recognized companies like Amazon and Facebook. And in the new day and age of investing, some businesses can go up over 500% in a single year, looking at something like NIO or Tesla. Now, these kind of investments largely go against the grain for traditional or value investors, but now with investing being very accessible for a lot of people, it is possible to get lucky and get involved in a crazy return like those offered by a lot of the new and exciting businesses that you can now find on the stock market. With new ETFs like ARK Innovation that has only been publicly traded since 2014, they have the potential for a far greater return, with ARK Innovation sitting at currently over 400% if you got in early enough in 2014, and this is far greater than the return you would get from a more traditional ETF like the S&P 500 that's been publicly traded since the late 1950s. And newer ETFs and more unestablished businesses are considered to be a more speculative or risky investment, but they're very popular these days and have seen a substantial growth that far exceeds that which is normally associated with a good stock market return. And a good return is normally 15% a year for an individual business, and in this day and age, individual business can go up 15% in just a week. So things really have changed with what is considered to be a good investment, but there's a lot of worry from traditional investors on where this new adaptation will take those who are just getting into the stock market, and if ultimately things will backfire on them in the long run. Of course, a substantial gain like the ones mentioned sitting at over 100% are few and far between, and often investors lack the discipline and will not dedicate the time to correctly research a business and find one that's actually worth holding on to for long term, say 5 or 10 years into the future. Arguably the best long-term investment that a traditional long-term value investor like say Warren Buffett or Charlie Munger will advertise to people is just investing consistently in the S&P 500, dollar cost averaging every month, setting aside an amount of money that you are willing to invest and that you don't need, and are able to keep in that index indefinitely, money that you can have sitting in there for 10, 20, 30 years into the future. So at the end of the day, it's up to you where that money goes. If you want to stick with a traditional way of investing, purely just put your money into something like the S&P 500, so your investment is spread out amongst multiple businesses, if you want to follow that quite traditional method. But if you're into the new style of investing where there's, say, a bit more risk involved, and the type of companies that you're picking or the type of companies that make up an ETF aren't as established and don't have, say, a 10-year plus track record, put your money into a new ETF like ARK Innovation ETF that include more enticing and exciting companies. And once you have the discipline to actually hold on to your investment for a long period of time, say 5 years or 10 years plus, and you don't get scared when you just see a little bit of red or small drop in share price, having the commitment to holding that company if it goes down 10%, 20%, 30%, and the only way you get that confidence is by actually understanding that business, its financials, its goal, and if that sector is actually worth holding on to. So with new companies, it takes a bit more strategy and a bit more dedication, but if you want a nice consistent return that is just going to give you 8 to 10% every year, go with the S&P 500. If you want a bit more risk, go with those new ETFs, ARK Genomic Revolution or ARK Innovation ETF. And if you want to go a bit riskier, you can start researching individual businesses, like say just investing in Facebook or Amazon or Microsoft. And you can play around, which companies do you want to go with? Do you want to go with nice, well-branded businesses that don't grow as quickly, something like Facebook, for example? Or do you want to go with newer, more exciting businesses in more developing sectors, like say Tesla or NIO when it comes to that electric vehicle, to that EV sector? So it's really up to you and how much risk you want to take. But at the end of the day, just make sure you start and get into the investing world, because once you start, it's really going to get quite interesting, and most likely you'll start adding more and more money. That $1,000 now might seem like a substantial portion of your income to put into the stock market, but the more you do it, the more comfortable you'll be with it, and you'll be putting in far more than just $1,000. Having a combination of ETFs and individual stocks can also be a good strategy. If you want to be more conservative, having more of your money in ETFs, say 60% ETFs and 40% in individual stocks, you can play around with the ratio and find out one that's good for you. But at the end of the day, the most important thing is getting into the stock market, because the worst thing you can do is just sit on the sideline, have all your money in cash in the bank, not really gaining any interest or doing anything for you, because in a bank you only get say 0.5 to 2% interest, where in the stock market you're guaranteed anywhere from 8 to 10% with a very safe investment like the S&P 500 ETF. And you have the potential to double or triple your money if you get in on companies like NIO and Tesla. But at the end of the day, businesses like that have a lot of speculation around them, so it's up to you to do your research and understand the business and make sure that your investment is good and worth holding. Otherwise, it can be a very stressful time when you see fluctuations in share price and big drops that happen from time to time. So the more research you do, the more confidence you can have, and the more dedicated you can be to holding your company long term and seeing that growth over a period of several years as opposed to a period of several months. So thanks for watching, appreciate the support. Remember, if you learned something new or enjoyed the content, make sure to hit that subscribe button and help support the channel. Look forward to seeing you guys in the next video.